We are looking at problem number 18 in the textbook. And the problem in the textbook is about a company called Preston Road. And Preston Road Inc. was organized last year when the founders contributed $9 million, that's a $9 million, and issued 3 million shares. And those were issued at a $1.25 par value. Now, par value is the value that is on the front of the stock certificate, and that's what it's valued at when the stock begins. Now, the company earned $750,000 in cash for the first year, and then what they decided to do with the cash was the owners decided to pay out dividends of $325,000 to every shareholder, not 325,000 individuals, but 325,000 to the entire pool of shareholders that they had, which would be 3 million shares. So what we need to do is we need to construct the equity section of Preston Road's balance sheet as at the end of the year. So the first thing that we're going to do is we are going to start off and we say we have this, and this is the start of it, and we're going to say common stock. That's what we're going to look at first. And then we're going to look at something called paid in excess second. And then we're going to look at total equity. So we had 3 million shares at $1.25, and then you multiply it out, which would be $3,750,000. You had paid in excess, which was 9 million from over here, so that was 9 million, and then you subtract out the 3.75 million, or it equals to be $5,250,000. So let's just go back over that. You had common stock issued, you had 3 million shares at $1.25 a piece, and that's what the value of the company is. So then we had this, what's called a paid in excess, which means that they put in $9 million into the bank account. Well, since they put in $9 million, we subtract the value of the stock. So the company has an excess value of $5.250 million. So the total equity of this company, of the extra money in the value of the stock, would be $9 million total. Okay. So you could do it another way too if we wanted to, which would be 9 million shares divided by $9 million divided by 3 million shares, which would give you $3. Okay. So here's what we need to do. We need to come in with the end of the year. So we are looking at this. So the retained earnings of $750,000. That was set up in the problem. So we take 750,000 minus 325,000. So let's just go back over what these numbers represent. 750,000. This is earned profits or income. Okay, that was earned. So then 325,000 of this was what they want to pay out in dividends, which would leave us $425,000 in the bank. Does this make sense? So you get $750,000, that's what we earned. We want to pay out $325,000 in dividends to our stockholders, and it gives us $425,000 in the bank. Well, what we want to do is we want to create this stock chart. This we call it. The equity section of Preston Road's balance sheet, which would be common stock. Common stock, 3 million times 125, which we did a few minutes ago, which would be 3,750,000. Then we would do paid in excess, which we know already, which was 5,250,000. And then we keep this retained earnings, which was this number right here, which would be 425,000. So then you add them. If you want to get the total equity, you would add them all together. But for the essence of the problem, this is what we are looking for right there. That is what we're looking for the problem. That whole section. If you have any questions, please refer back to the textbook, and you can read through this in the text pages.